Welcome back to the $50 Dividend Investor Podcast, the show that proves you do not need to be wealthy to start building wealth. I am your host, K.R. Talon, author of the $50 Dividend Investor, available on Amazon. Each episode, we take one powerful concept from the world of dividend investing and break it down in plain, everyday language. No jargon, no fluff, just a clear and honest roadmap for the everyday investor. Let's get into it.
Welcome to the table where the green meets the gold.
You have decided to start. You understand what dividends are. You know what a drip is and why compounding is the most powerful force in personal finance. And now you are sitting there staring at a screen with thousands of stocks to choose from, and you have absolutely no idea where to begin. That moment, that paralysis, is where most new investors give up before they ever get started. Today, we fix that. By the end of this episode, you are going to know exactly what to look for in a first dividend stock, what to avoid, and the simple 3-question checklist I use before buying anything. The same checklist I lay out in the $50 Dividend Investor. Welcome to Episode 3. Let's start with the most important mindset shift for a beginner picking their first dividend stock. You are not looking for the most exciting stock. You are not looking for the highest yield. You are not trying to find the next big thing. You're looking for boring, reliable, and consistent. I want you to fall in love with boring, because in dividend investing, boring is how you win. A company that has paid and grown its dividend every single year for the past 25 years without interruption is not exciting. It does not make headlines. Nobody at a dinner party is talking about it. But it has been quietly sending checks to its investors through recessions, market crashes, pandemics, and every other crisis the economy has thrown at it. That company is worth far more to a long-term dividend investor than any flashy high-growth stock that might pay a dividend this quarter and cut it the next. So what specifically are you looking for? There are 4 qualities that make a stock beginner-friendly for a dividend investor. The first is a stable dividend history. You want to see a company that has not just paid a dividend consistently, but has grown it consistently. A company that raised its dividend last year and the year before that and the year before that, going back a decade or more, is showing you something important about its financial health and its commitment to shareholders. That track record is not guaranteed to continue forever, but it is the closest thing to a reliable signal that dividend investing offers. The second quality is an accessible share price or fractional share availability. As a $50 investor, you need to be able to buy into a company at your budget. Some of the best dividend stocks in the world trade at hundreds of dollars per share, but fractional shares solve that problem entirely. Make sure your brokerage or DSPP allows fractional share purchases before you commit. The third quality is a direct purchase option. As I cover in the $50 Dividend Investor, many of the strongest dividend-paying companies in America offer direct stock purchase plans, meaning you can invest directly with the company, bypass brokerage fees entirely, and set up automatic monthly contributions at your pace. For a beginner with a limited budget, this is a significant advantage. The fourth quality is a track record that holds up through downturns. Pull up any stock you are considering and look at what happened to its dividend in 2008, in 2020, and in any other major market disruption in recent history. Did the company maintain its dividend? Did it cut it? Did it suspend it entirely? A company that kept paying and even raised its dividend during those periods is demonstrating exactly the kind of resilience you want behind your first investment. Now let's talk about dividend aristocrats, because this is the category of stocks that checks every single one of those boxes. A dividend aristocrat is a company in the S&P 500 that has increased its dividend every year for at least 25 consecutive years. Think about what that means for a moment. 25 years of consecutive annual increases. That covers the dot-com crash, the housing crisis, the pandemic, and every other economic storm of the past 3 decades. These are not lucky companies. These are companies with durable business models, strong cash flow, and a deep institutional commitment to rewarding their shareholders. Consumer staples companies, healthcare providers, industrial manufacturers, the kinds of businesses that people need regardless of what the economy is doing. These are the stocks I point beginner investors toward first, and they form the backbone of the portfolio framework in the $50 Dividend Investor. Before I give you the 3-question checklist, I want to address something that trips up almost every new investor: the temptation of a high dividend yield. You are scanning through stocks and you see one paying a 9% dividend yield. Another is paying 3%. Your instinct says take the 9%, that is 3 times more income. But here is what that instinct does not know. A yield that high is often a warning sign, not a reward. When a company's stock price drops sharply, usually because the market senses trouble ahead, the yield calculation goes up automatically because yield is just the annual dividend divided by the share price. So a high yield can mean the stock has fallen significantly, which often means investors are losing confidence in the company's ability to keep paying that dividend. This is called a yield trap, and it has burned more beginners than almost any other mistake in dividend investing. A 3% yield from a company that has grown its dividend by 8% annually for 20 years is worth far more to you over time than a 9% yield that gets cut in half next quarter. Consistency and growth beat headline numbers every single time. Now, here is the 3-question checklist from the $50 Dividend Investor that I use before buying any dividend stock. Question 1. Has this company paid and grown its dividend consistently for at least 10 years? If the answer is no, or if there were cuts or suspensions in that period, I want to understand exactly why before I proceed. Question 2. Is the payout ratio below 75%? The payout ratio tells you what percentage of the company's earnings are being used to pay the dividend. A ratio below 75% means the company has room to maintain and grow the dividend even if earnings dip temporarily. A ratio above 85 or 90% is a red flag. The company is paying out almost everything it earns, which leaves no cushion if things get difficult. Question 3. Does this company sell something people need regardless of the economy? This is the durability question. Companies that sell essential goods and services, things people buy in good times and bad, are far more likely to protect their dividends through downturns than companies dependent on consumer spending or economic growth. If you can answer yes to all 3 questions, you have a stock worth researching further. Now let's talk about the free tools you can use to research dividend stocks without paying for a single subscription. The first is Dividend.com, a free resource that gives you dividend history, yield, payout ratio, and growth rate for thousands of stocks in one place. The second is the DRIP Investing Resource Center at dripinvesting.org, which maintains free lists of dividend aristocrats and dividend kings, companies with 50 or more consecutive years of dividend increases, updated regularly. The third is Yahoo Finance, which allows you to pull up any stock, navigate to its financials, and see earnings, cash flow, and dividend history going back years. These 3 tools together give you everything you need to run the 3-question checklist on any stock before you invest a single dollar. No paid subscription, no premium account, just free public information used with a clear and simple framework. One final thought before we close today. Your first stock does not have to be perfect. It has to be sound. The goal of your first investment is not to find the single best dividend stock in the world. It is to start the habit, learn how to evaluate a company, watch your first dividend arrive, and build the confidence to make your second investment. The 3-question checklist keeps you away from the most common traps. The Dividend Aristocrat framework points you toward reliability, and the free tools give you everything you need to do your own research. That is a complete starting kit. Everything I have covered today is expanded in detail in the $50 Dividend Investor by K.R. Talon, available now on Amazon. Link is always in the description. Next week, we are tackling one of the most important concepts in building a long-term portfolio, the real difference between dividend yield and dividend growth, and why getting this wrong is one of the most expensive mistakes a new investor can make. Subscribe so you do not miss it. Start small, think long, build forever. And that is episode 3 of the $50 Dividend Investor Podcast. The 3-question checklist, the Dividend Aristocrat Framework, the free research tools. You now have everything you need to evaluate your first dividend stock with confidence. You do not need a financial advisor to do this. You do not need a premium subscription or a Wall Street connection. You need a clear framework and the willingness to use it. That is what this show is built on. If you are ready to go deeper, the $50 Dividend Investor by K.R. Talon is on Amazon, link in the description. It walks through stock selection, portfolio building, and drip setup in the same plain and honest language as this podcast. And if this episode helped you, share it with someone who is still waiting for the right moment to start investing. The right moment is now. Next week, we are breaking down dividend yield versus dividend growth, one of the most misunderstood topics in beginner investing and one of the most important to get right. I will see you there. Start small, think long, build forever.
Welcome to the table where the green meets the gold. Green meets the gold. I'm K.R. Talon, and we're planting seeds today, not just checking the ticker. Not just checking the ticker. You don't need a harvest to start. You don't need a harvest to start.